All right. Hey, everybody. Today, what I want to talk about is cash and accrual. And so, those are two different bases of accounting. We talked a little bit about it on the session Monday by identifying when and how revenues and expenses are recognized under a cash versus an accrual system. And what I want to, I want to reflect on the two bases in a little bit more of a conceptual way at first, discussing like what's the advantage of the accrual system, which one does US GAAP prefer, why does it side with accruals over cash, and does it leave cash out? And so we're going to talk a little bit about those things today. And then I'm going to work through a couple of problems that are at the end of your chapter one problem set, the study problems I have. And there's also a couple of problems in the McGraw-Hill Connect that you have to do a sort of cash to accrual conversion. So let's get to working on that. I have the document uploaded that I'm going to use in this session. It's under the same content folder, the 6263 Zoom hours. And so this is what I'm going to be talking about today, this one. So when we're looking at a cash versus accrual system, really again, the entire difference of these systems is based in when and under what criteria, really, we recognize expenses revenues. And in particular, the cash system we've discussed. Well, when we pay cash, when the company spends cash, they record that as an expense. They debit an expense and credit cash. Anytime they credit cash, they have to debit an expense because that is how the cash system works. The accrual system, anytime cash comes in, regardless of the source, that is a revenue under the cash basis system. So they debit cash and then always credit revenue. Now, the accrual system does recognize some instances when cash is paid, we recognize the expense. In some instances, when we receive cash, that we record a revenue. But the accrual system relies on the matching principle, which my pen doesn't want to work on that tone of ink, apparently. The matching principle, remember, is also called the expense recognition principle. So they are the same thing. It's telling me when to recognize an expense. And the realization principle is just another name for the revenue recognition principle. Same thing, tells me under an accrual system when I can recognize revenue. Now, under the accrual system, remember that basically we can recognize, so this is all under accrual. Expenses can be recognized. And when I say recognize, what I mean is that I've debited an expense account, right? That's recognizing an expense, that I actually record an expense, I debit it to increase it. So expenses can be recognized before cash is spent. So we do this a lot when we accrue interest, right? We're not making the interest payment yet, right? Maybe we have to pay it next month, but at the end of this month, we accrue interest expense for the amount of interest that um, I'm trying to say not accrued, for the amount of interest that built up during that month. So we accrue that interest as a debit to interest expense, a credit to interest payable before we actually pay it out. We could also recognize it when cash is spent. So an example of this is like our research and development expense. As we spend cash on R&D ventures for the company, If they're developing a patent or developing a new process, some new software, we will many times recognize a debit to research and development expense when we credit cash, or we could recognize the expense after cash is paid. So after cash is spent, and an example of like us recognizing expenses periods after cash is spent, you could think of depreciation expense because we bought PP&E, and in the periods after that we actually use that PP&E, we recognize depreciation expense. You could also think of this as like insurance expense from prepaid insurance. We set up a contract where we prepay, say, a year's worth of insurance, but we recognize the expense only as we're using it up. And this is the same thing. This is true that expenses can be recognized before cash is spent, when cash is spent, or after cash is spent. Same is true for revenues. Under an accrual system, we can recognize revenues before we receive cash, when we receive cash, or after the cash has been received, in periods after. So understand that the accrual system isn't taking anything away. It's actually encompassing not only some of the times when cash is paid, yeah, we'll recognize an expense under the accrual system. Or when we receive cash, we'll record a revenue under the accrual system. But then it adds this extra layer, this darker layer on the outside, when we can recognize revenues and expenses before or after cash is spent. So, given that discussion, then the first question tends to be like, well, which is better? And it's, a good question, which doesn't tend to have an easy answer. Um, it could just depend on the size of the company, right? Not every, or the size or the type of the company, not every uh, organization uses US GAAP. Nonprofits and government use different types of rules other than US GAAP. If the company owns a substantial amount of assets, you would be far better served using an accrual system because under a cash system, a lot of assets are not recorded. Does it employ a substantial amount of paid full-time workers versus voluntary workers? Again, this will get into some accrual issues that you would be required to use accrual accounting. Does it finance its operation? How does it finance its operations? If it's depending on bank loans, a lot of times the banks will want GAAP-based financial statements. And then of course, like what is the purpose of our analysis? So those are all like, situational questions. If we think about what the FASB says, the Financial Accounting Standards Board. Which one do they think is better? Well, the Financial Accounting Standards Board obviously created GAAP and uses GAAP as it's mandated that companies use GAAP in order to submit their reports and trade on public markets. So they do seem to come down on the side of accruals. But notice, right, the balance sheet and the income statement are accrual basis. Now, again, that doesn't mean they exclude cash-based information. They use the cash-based information and then add that extra layer on it to get the accrual system. There is, however, one financial statement that is purely cash flow, and that is the statement of cash flows, right? It's pure cash basis. There's absolutely no accrual information on the statement of cash flows. And in fact, in order to create it, we have to reverse a lot of the accruals that the company might have recorded in order to find the cash flow and prepare the statement. So it seems like there's a sort of split decision here, right? Because yes, the FASB uses the accrual system. The balance sheet and the income statement are definitely based on both the additional accrual layer given to us by the expense recognition and revenue recognition principles. But we also are supplied with the statement of cash flows, which gives that cash basis. So really, they offer complementary analysis. Okay. And one of the things I really wanted as a takeaway from this chapter is looking at how that accrual and cash basis accounting can come together in a single account. And one thing I do want to reiterate, just real quickly, I believe is said in the notes, but it's a pretty interesting concept that if we are looking to predict with financial statements future accrual income. So we're using, for example, net income at time t to predict net income in time t plus one or t plus two, wherever, right? Way out, future accounting. So if this is, for example, net income for the year 2025 to predict 2026 net income, 2027's net income. To do this, then we use then accrual based net income at time t is a better predictor than cash flow at time t. So that might not be blowing your mind, right? Because, well, yeah, of course, today's net income will be more likely to predict next year's net income because they're both accrual based. But what is interesting is that then when we talk about predicting future cash flow, so we're using cash flow at time t to predict, cash flow at time t plus one, next year's, the year after that, etc. Out there. Accrual-based net income is still the better predictor. So not only does it predict itself in future periods, but it is a better predictor than cash flow at time t to predict future cash flows. And that is a little bit more impressive of a feat. And for this reason, because financial statement users are interested in using present day information to extrapolate and predict the future, we use the accrual based system. We don't miss out on any of this cash information because there are situations when it's warranted that we recognize under an accrual system an expense when cash is spent or a revenue when cash is received. But then it, in addition, gives us that flexibility to recognize these things before cash is spent or after cash is spent when the situation warrants it, right? And then you're asking, well, when does the situation warrant it? You got to go back to yesterday and understand what are the criteria for recognizing revenue under revenue recognition. What are the then after we've recognized revenue, how do we decide what expenses to recognize in that period with this revenue? So I'm going to pause and see if there's any questions from those attending real quick. So given that, I want to look at a couple of problems then where we look at how we can figure out cash information or accrual information given some simple accounts that hopefully we're somewhat familiar with and see how this works. So what we have here is Norse company, Norse Incorporated, paid $33,000 into its prepaid insurance contracts for the year 2026. So for prepaid insurance, it started at 17,000. And at the end of the period, this account got up to 25,000, right? That was where the dust settled at the end of the accounting period for 2026. And it also received $73,000 of cash in advance during 20X6 for services that it provides. When we receive cash in advance of doing our contractual obligations. So maybe yeah, something real easy and kind of antiquated. We are a magazine that provides subscriptions to our customers. They pay us for a year's worth of subscription that, in advance, obviously. And then we send them our periodical, our magazine every month for 12 months. Well, the $73,000 of cash goes into unearned revenue. And remember, just so you're not thrown off by usages of deferred revenue, that tends to be the more common name for this account in professional settings. So that's part of the multitude of synonyms that you have to kind of put together that, okay, deferred revenue means unearned revenue, which both indicate an instance when the company has received cash before delivering a good or service. So what we have in this problem is cash information from this sentence. It said that we paid $33,000, and if we paid 33,000, the implication is cash. We received $73,000, and it actually says of cash. So this is my cash information up here, and then I have account information below in that table. What I need to do then is recognize that these accounts, and I'm going to make T accounts for them. And I highly recommend you practicing T accounts. At the beginning of the semester, they seem overkill to a lot of students. Um, by the end of the semester, most of the students have come around and said, never mind. Toward the end, they became very useful. And then even those that weren't convinced by the end of intermediate one said, okay, intermediate two, I definitely needed my T account. So just get used to using them. It's a great way to set up information. I live and die by them. And, this has been stuff I teach for the past, golly, I don't even want to think about it, maybe 15, 20 years. All right. So the prepaid insurance account starts at 17,000. Remember, this is an asset account. It's usually a current asset. Parts of it can be not current, but tends to be current. And then we end up with 25,000 here. And then for the unearned revenue, that's a liability account, and it starts at 38,000, and at the end of the year, it's down to 23,000. So with this cash information, what I would do is determine, all right, if I pay $33,000 of cash and start basically booking a contractual insurance contract with somebody, right? So I'm re-upping my insurance. I need to extend the life of my insurance contracts, and I pay 33,000 into that. Well, what does that look like in terms of a journal entry? Paying $33,000 into my prepaid insurance would debit prepaid insurance by that amount and would credit cash by that amount. So for this asset account, when cash is spent, it increases the asset account. So now we look at what we have here, and clearly it doesn't align because I started with 17,000. I added another $33,000 of asset of prepaid insurance to it. And 33,000 plus 17,000 is going to give me 50,000, not 25,000, right? So what that means is there must have been a credit here. There must have been something, an amount of money that a dollar value, I won't say an amount of money because that makes it sound like it has to be cash, but there's a dollar value that this account was credited by. And it must have been credited when we used some insurance up during the year, right? Because we started with 17 and we paid 33, but if we started with 17 and this is a prepaid insurance contract, months have passed. That means we've used up some of this contract, which means that we need to credit out the portions we've used. And when we use that contract and credit our prepaid accounts, we recognize expense. Right? This is our accrual system, recognizing the expense only as we've used it. So in order to figure out the dollar value of the debit and credit here, I just need to solve for the missing amount. So as I said, this would take me up to 50,000. Well, if I'm at 50,000 with just these two, then I have to reduce it by 25 to get it to 25. And the math, you might like want to go to an equation, and equations can get tricky as the accounting gets more complex. And that's all I'll say, because otherwise it'll get too confusing as to how it gets tricky. Just rest assured it does get tricky, and people will tend to mess it up if they just use equations. So that 25,000 is what I was missing as a credit to my prepaid insurance account. And knowing what I know about how the prepaid insurance account works, I know that therefore, when I put money into it, I'm debiting this account. That's the cash side of this account. And then when it's being reduced, I'm using up the insurance in recognizing the expense. So the accrual side is the credit side of this account. Not every account will have strict, okay, when cash affects it, it's on this side. When accruals affect it, it's on that side. But some of our most common accounts do just that, right? So we have both cash and accrual information, right, affecting this account. Let's look at deferred revenue. Now, deferred revenue, same idea. We're just working with a liability, a different sort of transaction. When we receive money in advance of services that I provide as a company, then I debit cash because money was received, but I need to credit something. I can't credit the revenue yet because if it's in advance of the services, it doesn't meet the revenue recognition principle. And so instead, I credit deferred or unearned revenue. You can use either on the exam or your homework. Well, the homework, McGraw-Hill has it has drop-down menus, so just select the one it gives you. But on the exam, deferred or unearned is fine. What I do always ask people to do, which I haven't been doing in all my examples, but almost anytime I ask for a journal entry on an exam, I'm going to ask you for the effects on assets, liabilities, equity, or net income by the account you debited or credited. So we recognize that cash in advance. Of course, that cash is an asset, but this cash then obligates me to provide services for $73,000 to this person who paid me the 73. All right. Well, this credits my deferred revenue account. And I do the same analysis. I think, wait, all right, 38 plus 73. So that should come up to 111,000, but I only have 23 as my ending balance. So I know there has to have been an amount that was debited to my deferred revenue. And deferred revenue is one of those accounts that tends to just have a cash side on the credit and an accrual side on the debit. So if I have 111,000 and it ends up at 23, that means that this amount must have been $88,000 debit. And if I debit deferred revenue for 88,000, now the question becomes, well, what do I credit? And in the case of deferred revenues being reduced, what that means then is the company is earning the revenue. They're able to recognize it through the revenue recognition principle because they've earned it. And so now they get to credit revenue for $88,000, which corresponds to the fact that, hey, they have $88,000 less to earn on this particular contract. So, you know, that students who remember a little bit more about adjusting entries and whatnot will realize that these are both adjusting entries. These are both accrual adjusting entries, a recognition of revenue at the end of the period, a recognition of insurance expense at the end of the period. And we'll talk a little bit more about those to refresh your mind in chapter two. Alex will do so as well as you make your way through the pie. It'll test the hell out of some adjusting entries for you. But this is, again, just an example where we can think about some accounts having a debit, an accrual side and a cash side. So I got one more. There's a few more of these in your chapter one study problems. I just took the first two. Uh, in this case, again, we're getting cash information, right? So we made cash interest payments of 130,000 during 20x6, received cash of $74,000 on interest due from investments my company made, right? So I have money that I've borrowed and I have money that I've invested. So the cash interest payments that were made, those are going to pay off accrued interest expense. So this is the money that this bank has borrowed that it's paying interest on. Whereas the $74,000 of received cash is settling interest accrued from investments. So basically, it's just what side of the loan agreement are we on? When we are paying the cash, we're on the borrower side. When we're receiving cash, we're on the investor side, the lender side. Okay. So now we just correspond this information with the accounts that we have below. Um, in this case, again, both are missing the accrual information, just like they were in the first one. So we got interest payable, which is a liability, and interest receivable, which is an asset. The interest receivable is starting at 35,000. It ends at 49,000. The interest payable is starting at 52,000 and is ending up at 39,000. So this is where our T accounts begin and end. In terms of understanding what a T account is giving me, of course, it's a beginning balance and an ending balance, but understand that also what that actually corresponds to is what is on the balance sheet. We would see for interest receivable, we'd see 35,000 in one column, 49,000 in the other column. This would be the year we're reporting for. This would be the end of the prior year. And again, same here. This would be the year we're reporting for, right? The most current year. This would be the end of the prior year. We always have at least two dates on the balance sheet so that investors can compare how totals moved over time. And so these two balances correspond to what we would find on the balance sheet. All right, so let's bring in our cash information. We have cash interest payments of 130,000. And so if someone's paying us cash, then that means that they had, I'm sorry, we made and this is an easy mistake to make, so make sure you're on the right side of the transaction. The bank made cash payments of 130,000, so they're paying off an obligation, right? So they're paying off their interest payable. That started with $52,000 of interest that needed to be paid. They paid 130. Well, either they overpaid, so that just came from here, because when we paid that interest, we would debit interest payable and credit cash. for 130 each. Well, either we paid more interest than we even owed, or there was some interest that was accrued over the time, over this year, such that even though we started with 52, we paid 130, we still owe 39. And so, in order for that to work, so that we take our beginning, subtract the 130, add the amount that accrued during the period in order to get to 39, we just need to solve the T account. And it looks like we're going to need 117,000 in order for us to start at 52, add 117, subtract 130, and get to 39. This would be, again, an adjusting entry that would need to be made at the end of the period where we are crediting interest payable. We're accruing interest expense into a payable account and recognizing that interest expense in the appropriate period by the matching principal. And just filling out the effects there. For the receivable, our cash information is that we received cash of $74,000 on interest due from our investments. So people are paying us interest here. Well, we were due to receive 35,000, but somehow we got checks for $74,000 that paid off interest. Right? So this is going to reduce the interest we are due to receive because when we receive that cash, debit cash for 74, and people are paying off the interest they owe us, then we are owed, we are entitled to receive less interest. So our interest receivable goes down. We basically get a cash asset in place of our interest receivable asset. But again, it doesn't line up because we weren't even owed $74,000 at the start of the period, which means that we must have accrued more interest revenue during the period. How much did we accrue during the period? Well, we started at 35, we got paid off 74. So that would put us in a negative spot until we factor in the idea that we must have earned and accrued more interest during the period. And if we solve, we get $88,000 must have been accrued for this period. That's a debit to interest receivable and a credit to interest revenue, both for $88,000. And, oops, sorry, that's not down. Up assets and up net income. Right? That's what those would do. And again, both of those are adjusting entries. So I would recommend going through those end of chapter problems. I mean, definitely paying attention to more than just the ones I did. And that I think there's a number three and number four, maybe a number five. But yeah, example seven has a few of those in there. And as I mentioned, I think it's question 13 on your Connect chapter one homework. At least chapter 13 has, or not chapter 13, chapter one has problem 13 in there where you're using cash and accrual information to determine what happened to the company.